Excellent, thank you. So, firstly, it's great to see so many familiar faces, but actually also some new faces. And it's probably just worth refreshing everybody because we don't have a slide on our journey, but actually the journey that Mercia's made. Martin and I, we floated the business on AIM 2014, back in 2014, December 2014, with about 30 million, give or take, in third-party funds under management, a small office in Birmingham. And the aim was to scale the business, delivering capital across the UK by sort of city and regional bases. And really today is quite a nice sort of progress update on where we are on that scaling of the business. I'm assuming everybody in here can speed read, so I will now move on to the next slide. So just by some introductions. So I'm co-founder of Mercia, spent quite a few years actually in technology transfer, commercializing tech and investing in tech businesses. I noticed actually a significant gap that if you were a young business and you're outside of London, Oxford and Cambridge, you really struggled to access not just capital but support to grow your business. And that really was at the heart of what we set out to do. Martin?
Good evening, everyone. I've been with Mark since the autumn of 2014, and my background is either public company CFOs or private equity backed, and all of them have been in technology-based businesses.
You'll hear from the numbers, so I can actually point to Martin on any difficult questions on the numbers in a moment. Just in terms of highlights, actually, so these are the results of our prelims this year. So a few months now out of date, but that's what these numbers will speak to, but also a little bit about what we're looking to as we go forwards. So, as I said, we started off with about 30 million in funds under management. Today, that's 1.4 billion now in assets under management, and that's grown from a shade under 960 million the year before. We've realised cash is 71 million from our investment activity. We've heard from other speakers about the subdued economy and markets, etc. That's down from about 155 million, but what I'm pleased to say is actually the level of realisations continues strongly into this financial year. We've invested in that 12-month period 165 million pounds. That's up from 124 million, and that reflects really the pace of growth in terms of the funds under management that we manage. And I think critically, 378 million of that 1.4 billion is in unrestricted cash. So we have a lot of cash across the various funds, and I'll talk to those different funds and the liquidity in them in a moment. Group revenue, Martin will talk to the numbers, but that's grown obviously from 23 million up to nearly 26 million. Adjusted operating profit, 7.6 million. NAV per share, fairly static, again, as you would expect in the current market, 45.4 pence. And we're profitable. We're dividend paying. 0.53 pence was the H2 declaration on the dividend, taking that to a full year of 0.86 pence. Very much against what we refer to as a progressive dividend policy as the dividend grows year on year. Just a quick slide on the model itself. So we have a strong balance sheet. We have a strong cash position. Our cash on hand has two purposes. We are very often an LP, an investor in our own funds that we manage, and we also will on occasions invest in a business that's within the funds or alongside the funds. We've got about 20 businesses that we hold on our balance sheet in that respect, and that's out of a portfolio of about 400 or 500 businesses that sit across our funds. The fund management operation is a profitable operation and covers the operating costs, etc., and supports that dividend going forwards. And those two pools of capital work quite synergistically alongside each other. Just in terms of the assets under management, we class those in respect of ventures, private equity, debt, and our own proprietary capital. Within ventures, and this is very much the early point about trying to connect and link up our pools of capital. If you're an individual or a team looking for money, you're looking for money. You're not necessarily looking for early venture, late venture, private equity debt. You have a need for capital. It is our role to make sure you get the right sort of capital at the right time. Internally, we divide up Mercia Ventures into early stage venture and then later stage scale up capital. And that means within ventures we can write a cheque from as small as £500,000 up to 10 million, and we can go further than 10 million on occasions as well. Private equity, we're writing cheques of 2 to 5 million. That's a part of the business we intend to scale and grow. And then again, within debt, we can write cheques as small as 200,000, again, up to 10 million plus. So typically our sweet spot is £500,000 to 10 million, whether that's private equity, venture or debt. And back to the unrestricted cash, the free cash, approximately 25 to 30% of each asset class has got free cash position in it. And that goes right across the suite of those different asset classes. And that's very important as we continue to invest through the cycle, which is something you'll hear from different presenters, I'm sure, where actually your best returns are made when the investments are the cheapest and best price. So there's a lot of value out there at the moment, and this is where we are investing strongly for that future returns. And the addressable market, we are, as I said, very much almost like an impact investor. We're investing across the UK. We're investing in businesses that others don't see. And we're using discrete pools of capital to do that, focused exclusively in the UK. We only invest across the UK from something like our 11 offices across the UK. So we like to invest in markets that we're physically present in. And we split those pools of capital down into retail, public sector, institutional. And so within retail, we invest through, I'm sure a number of you are familiar with enterprise investment schemes, EIS, and venture capital trust, VCTs. So we invest retail capital carefully through those vehicles. We occupy about 5% of the market. We are growing fast in both of those areas and anticipate growing further market share within EIS and VCT. Within public sector, British Business Bank, that a number of you may be familiar with, we manage a material amount of their capital, regional capital across the UK. Again, we manage about 20% of the existing regional funds. There's a next generation of regional funds coming out and going through a formal process at the moment, and we are bidding on those funds as well to follow on from the good work that we've done historically. And then institutional, we split institutional capital across our private equity and our debt and property groups. And what's quite interesting, back to my point about being an impact investor, we're investing in regions, we're creating jobs, we're creating value and commercial returns back to our investors, is that the institutional funds tend to allocate capital out of their impact area. And that means that houses like Mercia are more amenable to them in terms of investing. So we have some good, strong institutional names across our funds, and again, we would expect to expand that part of the business. So really, in summary, this slide shows that we're growing quickly, we've got a modest market share, our track record speaks for itself in terms of performance, and we expect to continue that accelerated growth going forwards. Martin.
Thanks, Mark. I think the story of the last 12 months is really the 50% growth in our profitable assets under management. And we started last year with just under £1 billion. We added 415 million when we acquired Frontier Development Capital from our own cash resources in December last year, but also 134 million of organic new funds raised, additional funds, relatively small given the market backdrop of technology companies, reduction in fair values mainly across our EIS and VCT asset classes of about £29 million, but we also paid £42 million out in dividends to our own shareholders and to our VCT shareholders. So despite those 42 million of outflows, small reduction in fair values, you can see that at the end of March 23, we managed to grow by 50% to 1.4 billion. This slide just shows you the types of asset classes that we're managing, where the money comes from, who gives us their money to invest, and then the typical fund types that we're managing. And I think one of the key points here is not just how well the asset classes, the investor types, and the fund types are spread, but that of our total revenues, 80% roughly is recurring and contracted. So we are self-billing either on a quarterly basis or a half-yearly basis, 80% of our own revenues, which is obviously no credit control issues, which is a great place to be. So as you can see here, well spread. Where our debt part of our business now with the acquisition of FDC is up to just over £500 million, and our venture asset class is now over 600 million. And then by investor types, Retail is now really pushing ahead. That's a combination of our EIS and our VCTs at 441 million. And then we have institutional and public sector as well, the likes of British Business Bank, as we've said, and pension funds. And over here, slightly askew here down at the bottom, but again, you can see the different types of asset class, again, quite well spread as well by fund type. Thanks, Mark. So this was our annual results. The underlying story was revenue increase of 12%, but the preceding year it had 2.6 million of one-off performance fees from our VCT. So in fact, the underlying growth was really good. The difference between our total revenues and our total expenses, about 5 million. You could describe that as EBITDA. We call it net revenues within our business. That's pretty good growth. In a tough market for public markets and private market valuations, you can see here that the balance, we sort of balanced out our fair value uplifts and our loss on disposals. But we remained profitable across the year, strong finance income from a range of sources. And actually, as I say, in a pretty tough year for the backdrop, we performed really well. And since we came to the market, I think we said before, for those of you who've been with us before, the night before we floated, I think our balance sheet was about £10 million. We've managed to get it up to £203 million now. You won't see any debt on there. And the dominant numbers really are the 136 million of the value of the balance sheet portfolio that we've built up over the approaching 9 years now, and nearly 38 million of cash at March. And as we said, as our chairman said in the AGM statement a couple of weeks ago, we're still at sort of 35 million circa at the moment, which is, again, no debt. And of course, the big change over the last 12 months has been the movement up in deposit rates. So we spent the first sort of 8 years of our life earning nothing on our money, on shareholders' money. And now we're sort of touching just under 5%. We still haven't changed our treasury policy. It's still preservation. I remember at one of our early board meetings, one of our Neds said, "Whatever you do, Martin, don't lose it." So we've always adopted that approach first. So it's don't lose it. Keep it available. So we have all of our money now, particularly after things like Silicon Valley Bank and obviously the concerns around Metro Bank. All of our money is on overnight. It's on very short-term deposit. And we do have some money in money market funds, but we're with BlackRock. So again, we're very cautious, but we're earning about 5% now, which is an incredible transformation in terms of the amount of money we're earning from bank interest. So it's a fantastic balance sheet. And then in our cash flow statement, we do generate cash. We are paying a yield. We've invested about, last year, overall, in total, about 21 million. Our typical run rate will probably be about 15 million a year. So you might ask, why do you hold so much cash? Well, because two things really. One is we always want to have 2 years' worth of investment capacity. And secondly, because we must always pass our going concern test with our auditors. And we never want to be in a situation, as unfortunately many AIM companies have been in the last 12 months or so, of struggling to convince their auditors that they are still a going concern 15 months after their year end. So, the acquisition of FTC was a key number. The initial consideration was 5.5 million, and that says nearly 7 because we also acquired with the business 1.5 million of cash, which of course came back to us. And at the end of this month, we will pay that 0.53 pence final dividend, which was approved by our shareholders at the annual general meeting a couple of weeks ago. And finally, from me for the moment, again, as we've shown you before, for a sort of a small AIM company, we're blessed to have a fantastic shareholder base of blue chip institutions and, of course, yourselves. 10% of our share register is with individual investors. So for the moment, thank you very much.
Thank you, Martin. So just the last few slides. So Martin talked about the investments that we've made. Obviously, those are from our direct investments, not through our managed funds. And so this one slide gives an overview of all of the holdings that we have on our balance sheet. So these are direct investments where we've invested alongside the funds. The businesses have been built up over time through the funds. The number one holding there being Endreams, which I remember quite dearly before we IPO'd. So it's a long journey sometimes, these can be. And we invested via our EIS funds. And actually a secondary event took place, which our EIS investors were released from that and made some good money actually on that business. And it takes it all the way through. You can see the year when we first invested. You can see the value of the holding. You can see the amount of cash we've invested, realised fair value movements all the way across to the right-hand side, both in terms of the value we're holding at, but I think quite importantly, the percentage of the business that we hold. So the balance sheet has typically quite material stakes in these businesses, often 20, 30, 40%. And the reason for that is that the businesses that we back, certainly with the balance sheet and with our equity funds, will almost all be trade sales. It's very rare for us to IPO. I think we have one listed business actually in there. They're generally trade sales, and in the UK, the average trade sale for a business is just over £20 million. We are typically selling our businesses between 20 and 200 million, and so therefore owning a big piece of a relatively small pie is an important thing for the balance sheet to do. And so that is very much at the heart of our model, is that through our funds and through our balance sheet, we tend to build quite material stakes in these businesses. So why hold a share in Mercia? As you'll have seen from Martin's slide, about 17% of the board, the management employees own shares. Martin and I own shares within Mercia, and we've acquired shares over the years as well. And we think, to Martin's point on the recurring revenue, what we have is a business now that has very long-term revenue visibility. These are typically either evergreen or 10-year funds, many of which are only 3, 4, 5 years into that 10-year journey, and we are always raising new funds. It's profitable, and the balance sheet is evergreen, and that's really important. We're debt-free. The acquisition that Martin referred to, FDC, we bought within our own cash resources. We do not intend to be raising money. We have a very strong balance sheet. And so that evergreen nature and the sustainability of this business, I think, is critical. As I've mentioned, 85% of our AUM is third-party funds. So we've come a long way from the circa 30 million in funds under management to the 1.4 billion and growing at the moment. We're a proactive, hands-on investor that typically commands a higher management fee because of the resource that we have to put to work in these businesses. The blended fee across the group is 2%. We see strong organic growth across all the asset classes that we manage, and we are looking at building those over the coming 6 and 12 months as well. Diversified in terms of the direct investment portfolio, but also, is Mercia a growth or is it a value business to hold? I mean, we've got on today's price, over 40% discount just against our NAV per share. So forget the value of the fund management business. So that's something that I guess is haunting a lot of individuals, a lot of management teams that are currently listed, is that there's some good value out there to be had. The liquidity is strong. So across our funds, we can keep investing. If we didn't raise any new funds, we have several years of investment firepower, if you like, in our managed funds and our balance sheet as well. As I've said, employees are aligned. Every employee at Mercia has share options. A lot of the management team, the board, have equity within the business. We have a progressive dividend as we continue to grow that. In this period, we've seen funds inflows continuing, 23 million of funds inflows. That's just from, frankly, investors wanting to put more money into the funds rather than us raising new funds. So that, again, is, I think, a support for the approach and the investment thesis that we operate in. Thank you ever so much for your attention.
Thank you very much. Lovely. Thank you very much, Mark. Thank you, Martin. Any questions? Gentleman here, please.
Hiya. On the P&L account, you had a couple of million plus in amortization of intangible assets.
Yes.
What are the intangible assets?
So, under international financial reporting standards, when you buy a business, you have to break the purchase price down by the constituent elements of what you've bought. So if you're buying a manufacturing business, there's a fair chance the balance sheet of that business will a lot of plant and machinery. For a financial services business, there's pretty much nothing you'll find on the balance sheet. So therefore, what are you buying? And what you're buying is a combination of two things generally. One is goodwill, and one is what's called intangible assets, which is the discounted future cash flows expected to arise from the business that you buy. And so for the intangible asset part of the purchase price, having calculated that number, you then have to amortize it over a period of time, each year through the face of your P&L.
So it's essentially write off on a partial element of acquisition.
Yeah,
previous
that's
acquisitions.
absolutely right. You are writing off essentially part of the purchase price through your P&L account. You've already paid the money out, so it's a non-cash item, but it goes through the face of the P&L. But the money's already been paid out and the business is generating profits.
Thanks.
And actually, on that question of FDC, how's it going so far? Touching wood always. It's going very well, thank you.
Please.
Yeah, sorry. Great presentation. I've got so many questions, but I'll stick to a few. What am I missing? I mean, a 40% discount. I mean, is that because the valuation, I mean, market's valuing what incorrectly? But your dividend, you say you got progressive dividend now, that you're getting paid 5% in your cash. I mean, all of that's going to be covered by half of that dividend is going to be covered by the interest you're getting. So when, are you going to progress it more than the interest you're going to be getting in that? And you said you're raising no money, but I'm a bit confused there. I thought every year there's like a VCT thing where people raise money.
We mean from the PLC. Yeah. We're not coming back. We have no plans to come back to you, shareholders, to raise money, particularly at the discount to NAV.
Yeah. So I'll stick to those questions. So, I mean,
with you, Martin.
I mean,
you could be.
Are you considering ever to pay when you realise some money in a business? Are you ever considering to pay out some of it to the shareholders rather than reinvest it?
That's a really good. Perhaps if I can sort of focus on that question, if I may, because from time to time we do get asked about, share buybacks. So we never rule anything out, and if we did have an exceptional exit, and if we felt we had nothing better to do with the money on behalf of our shareholders, then yes, we would make a distribution. The reason why, with £38 million in the bank at the end of March, 35 circa now, we won't do that, is because if you actually ran the maths on a £10 million share buyback, you would be essentially spending 26% of your available cash, and actually when you do the maths, you only get a 4% increase in your NAV per share, and so that's one part of the equation. The other part of the equation, that it just doesn't work. Share buybacks for companies of our size in our sector don't work, because although you should expect a 4%, even if you thought, well, 4% sounds okay, if you look at what's happened to IP Group and Augmentum FinTech in our sector in the last 12 months, IP Group spent £30 million, and then think of the opportunity costs of the bank interest they're not earning on that 30 million now, right? Their discount to NAV has not narrowed at all. So it's great in theory, but actually in practice for businesses like us in our sector, it's not something that we would do today. And as I said earlier, the other reason is because A, we do think we've got better things to do with our money, such as acquisitions, and secondly, we want to keep approximately a 2-year runway of investment, so that if we go through a barren period and we don't sell anything, we don't have to panic in terms of going concern.
I think that on the theme earlier of the controllables and uncontrollables, the sentiment against what is the balance sheet portfolio is an uncontrollable at the moment, just because of the general economic gloom. However, the controllable is us scaling our fund management operation. We're delivering an exemplary track record across all of those. There is great opportunity organically, and FDC shows there's great value out there on an acquisitive basis as well. So the controllables for us is scale the FUM.
Yeah, I mean maybe because of the interest rates, when people are looking for a return, and there are companies out there that say, okay, we're going to pay out 1% of our quarterly net asset value as a dividend.
Yes.
I mean, Apex, which is in venture cap, they pay out 5% of the net asset value every year as a dividend.
Yes.
Yeah. So I mean, have you not ever going to consider something like that?
So there's a very good reason why we have described our dividend policy, which we introduced a couple of years ago, as progressive. The idea being is that we hope to increase it every year, gradually. And the reason we wouldn't commit ourselves to some form of cover ratio, whether it was NAV per share, whether it was X times, X percent of profits, is because even if you look at these last 2 years, the 2 years here, right, you can see here that our profitability is lumpy, and therefore that would be a hostage to fortune if we said we're going to pay out, a percentage of operating profit. Because the next year, right, if your operating profit was lower because you hadn't sold anything in that particular year at profit, then you'd have shareholders, or the city would be going, oh, your dividend's gone down. What's happening? When there's actually nothing wrong with the business. So
Stop me.
So we feel that the idea of being able to increase the dividend year on year, irrespective of peaks and troughs in year-on-year performance, is the right way to go.
Just quickly, that discount to NAV, if you look at the listed private equity space, it's pretty consistent with most of the peers on there.
Yeah, and it is no consolation in the short term to our sort of very loyal and patient shareholders, our discount, but as some of you will have heard me say before, that we are the least worst discount of our small peer group.
Question here, please.
Thank you, gentlemen, for a very interesting presentation. Looking at this from an investor's point of view, I note that if I'd held your shares for 3 months, I'd have lost 6.92%. If I'd held them for 6, I'd have lost 9.38%. And if I'd held them for 5 years, I'd have lost 22.46%. I might be mildly reassured, if only mildly, by the fact that that loss is shared by people who are similarly invested within your company. But it would be somewhat better, in my opinion, to see positive figures. And I wonder if you could comment on that. Before doing so, I should also make one point about the discount to net asset value, which is reflected across the majority, certainly, and probably all of the private equity listed companies at the moment. So there are opportunities to buy at similar rates, and one must reasonably, as my esteemed colleague to my left did, question why that is the case. And I think it is primarily because the net asset value is an extremely subjective affair from my view of it. And I have in mind a private company in which I was regrettably invested, which was showing a net asset value of some £380 million and was sold by its shareholders for 50 million. So net asset values give me a nervous tick. I wonder if you could comment about yours and why I should be attracted at the possibility of sitting for 5 years and getting another 22% discount on my money.
Well, so I was once told that you cannot control the share price, because if you can and do, you might find yourself in prison. So that's my first answer on share price. So the share price is not a result of something we're doing. It's frankly, it's the dynamic of more buyers and sellers, or more sellers and buyers. And we are in a market, you saw our share register, which is excellent, but we are in a market where almost every single one of those is suffering, and has been now for a number of years since the Ukraine-Russia thing, on redemptions. So it is, unfortunately, we're not on our own. The small cap end of the market, as I'm sure a number of you are familiar with, has been pretty much beaten up by not private investors selling and buying, but by institutions selling out.
Yeah, and you make some very good points there, but if you were to look at our share price in January 2022, not that long ago, which was at 42 pence, so we were very close to NAV per share, we were very close to equilibrium. And then, of course, as Mark just mentioned, two things happened. The tech sell-off started at the beginning of 2022, and then, of course, in February, Russia invaded Ukraine. And since then, understandably, particularly retail investors have been very, very cautious about where their cash is. And in those situations, and for a lot of small cap companies like ourselves, our share price is more often than not moved by the buying and the selling by retail shareholders than it is by institutions. Because in most cases, institutions will sell at the mid-market price to another institution, and that, although you see quite high trading volumes, you don't see a price move. When you often see a price move is sentiment amongst individual investors. And understandably, for many individual investors in small cap companies, particularly in the tech sector in the last, approaching 2 years now, people have been extremely cautious. The fundamentals of this business, though, are sound, right? We have no debt, right? We have a very large balance sheet. We're profitable every day of the week. We're generating cash every day of the week, right? We have really good growth prospects in our. We don't have to buy any other businesses to keep growing our funds under management. One thing I didn't mention in that first slide, what you didn't see there was a column that said outflows, right? Which you'll see for many asset managers of public equities. So we're very fortunate, as Mark said, those are closed-end funds. So as long as we keep doing the right thing for our fund investors, we have great prospects for this business, and I've bored Mark for 9 years now, that sooner or later, if you keep doing the right things, your share price will reflect your performance, even if it isn't today.
One last question, please.
Sorry, going back to, I guess, the underlying believability or not of the net asset value.
Yeah. Yeah.
I mean, essentially, the stuff that people don't like to believe is tech at the end of the day, because it can be worth a fortune or it can be worth practically nothing. What proportion of the on-balance sheet and the funds under management, more broadly, are loosely classifiable as tech, whether bio or otherwise?
Yeah, I mean, you would, I mean, I'll flick to the slide. You would classify them all within the tech space, I would say. Yeah, I mean, and they are, but you know, tech is a broad church. Yeah. So you've got N-Dreams, which is actually break even, but it's a VR business. It's scaling and growing fastly, so it doesn't need money. You've got Soccer Manager, which is called Invincible Studios, really growing fast, doesn't need any more money, but it's a gaming company. You've got, I mean, you can pick any one of that. The one thing that defines an investment that we do is they typically don't need a lot of money. So we can usually support them within their own right. And actually, if you look over the years of our exits that we've made, they have all been either above or materially above our holding value. We've been very careful on our valuation basis across both our funds and onto our balance sheet. But I would broadly define them all within the technology space, but across a broad church of tech, from software through to gaming, through to engineering, advanced materials, and then life sciences. But even our life sciences businesses are typically in the sort of materials, they're in the med tech space. So again, modest capital needs, they're not therapeutics.
And inevitably, and certainly since Neil Woodford sort of left the space, there's been considerable scepticism, on many occasions justified, sadly with businesses such as Allied Mines, of the valuations, the fair values of unquoted companies. So we understand that. We've always, Mark and I have always taken since day one a prudent approach to our valuation methodologies, and one of the things we do to try and give investors such as yourselves confidence in these valuations is that even though as an AIM company we do not have to have our interim results audit reviewed by our auditors, you only have to have it done annually, we have it done every 6 months. So we do subject ourselves not to just an annual scrutiny of our fair values, but a 6 monthly scrutiny as well. So that doesn't guarantee that everything will go to plan, that we'll sell everything above holding value, but we try and be as transparent and as open as we can.
Gentlemen, it's been terrific. Thank you very much indeed.